Okay, welcome back, everybody. So we had our test on Wednesday. I'll have those tests graded and back to everyone by the latest on Monday. My goal is to have them posted into Moodle, into the grade book at some point over the weekend, maybe even today. But at the latest, I'll have them for everyone on Monday. My original plan for today was just to do the time value of money module. I want to kick that back until after chapter 6. I've changed my mind. I want to get a few more documents prepared before I go over that one. So we're gonna skip this for right now, but we will revisit this and do a quick one day class session on that, and then have a quick little quiz on it. Um, so today, what I want to do is hop into chapter 6 right here. Okay, so chapter 6. Okay, so this is dealing with cash and receivables. So before we jump into this, is there anything just off the top of your head that comes to your mind when we think of cash? We'll start with that, with cash. Is it just the actual physical cash? Is that all that really comes to your mind when we think of cash? Okay, what about receivables? What type of receivables do you think companies could have? What comes to your mind when you think of receivables?
I think of people playing with credit.
Right. So just trade receivables, right? Stuff that arises throughout the business, right? So both those are right. There's a couple more in each category. There's more so in cash than in the receivables one, but we'll get into them. Um, so here's pretty much our objectives for this chapter. Identify items of cash and cash equivalents. Understand the importance of cash controls. Define and identify different types of receivables. Explain the accounting issues associated with accounts receivable. Explain the estimation of uncollectible accounts receivable and its effect on the valuation of receivables. Explain how to account for secured borrowings and sales of accounts receivable, and account for short-term notes receivable. Okay, and we might get into this appendix here if we have time. We'll see how the chapter goes here. Okay, so introduction here. Financial statement users focus on a variety of information in making credit and investment decisions. We know that that's the main overall purpose of financial accounting, is for the external users in their decision making. Investors and creditors are interested in the company's financial flexibility, which is the company's ability to use its financial resources to meet its obligations and to respond to new business opportunities. Um, these stakeholders are particularly concerned with the liquidity, the availability of a company's liquid assets to settle its obligations. So once again, here's the concept of liquidity coming back again, which is obviously we know just how fast we can convert an asset into the cash. Okay, so what exactly is cash here? Okay, so it says here it's the most liquid of all assets, right? We know that we're used to making transactions with cash. A lot of times we might have some cash in our pockets. We're used to seeing the dollar bills or some coins or whatever it might be. Um, but right here it says here that cash can also include the following things. So coins and currency, we've established that. That's what we're talking about. Unrestricted funds on deposit with the bank, so like checking accounts, stuff like that. So that's not going to be cash in our physical presence, but we know we have access to it. We have a agent, meaning the bank, that's holding on to our funds for us. So if we can access those funds, that's considered cash. Checks and money orders. So if we're holding checks that we haven't cashed yet, that's considered cash. So if you wrote me a check and it's not post dated, then I can consider that cash, because then I can just go and cash it or deposit it in my bank, and it's mine. Money orders, we know what those are. Bank drafts, undeposited credit card sales receipts. So all these are considered cash items. On the other hand, these are considered non-cash items. Sinking funds, we know that's where a company deposits it into those things. So those are earmarked. So it's the same thing as being appropriated. We can't account that as cash because they're earmarked for another purpose. CDs, certificate of deposits, these are usually longer, shorter long term, but it's longer than a 90-day rule. So we're not going to be able to count those as cash. Bank overdrafts, obviously, that's where we spent too much money. That's not cash. That's a liability. um, Post-dated checks, that's where someone gives us a check. We know that we have to wait for maybe a week or two before we can cash it. So that's not going to be considered a cash. It'll be considered a receivable because we're going to wait to receive that money, even though we have the medium of exchange in our hand, that check, but it's post dated, so we have to wait until that actual post dated date in order to switch it from a receivable to cash. Travel advances, um, cryptocurrencies, meaning the digital currencies that we're used to, like Bitcoin and stuff like that. That's not considered cash. And required deposits are called compensating balances because they compensate the bank for granting the loan. That is not cash as well. So right here, this is just a little list of some classification of cash and non-cash items. We won't read through all of them here. I won't bore you, but we can see coin and currency, that's cash. Same thing we just talked about with demand deposits, negotiable foreign currencies. These are all cash. And then you can see here we get into different things. Sinking funds, that's long-term investment. CDs, short-term, and this same thing we just went over. It's just putting in a chart. So cash and cash equivalents, pretty much the majority of companies use the line item cash and cash equivalents on their balance sheet as opposed to just cash. They could have them separate, cash and then cash equivalents, but usually it's combined. Um, and the reason being is because cash equivalents in terms of GAAP is considered the same thing as cash. Um, what do you think a cash equivalent would be?
Well, cash equivalents are like checks and checking accounts.
Yeah, but that is cash.
Cash, sorry.
But a cash equivalent. What would be a cash equivalent?
Like available for sale securities.
It's
Short term.
anything that's less than 90 days, right? So it's any item less than 90 days. You're on the right track there. So it says here cash equivalents are short-term, highly liquid investments. So it could be, an available for sale, whatever it would be, and however you're holding it. If the maturity date is less than 3 months, then it's considered a cash equivalent. And the reason being, when you hold these little short-term investments less than 3 months, the reason why that's the rule that it's a cash equivalent is because from the time you purchase it within those 90 days, the chances of the interest rate or anything changing is going to be so immaterial that it's going to be equivalent to what the actual present value of that amount would be within that 90 days. Does that make sense? So the risk is so little with the change in interest rate and stuff. Um, so that's cash equivalents. This is just a little snapshot of just a real report of the cash and cash equivalents for the Starbucks Corporation. So you can see it's in millions. They have the comparative data from 16 to 17 on October. Um, then we can see within the assets section, it's in current assets, and it's always going to be listed first, right? So cash and cash equivalents is always listed first, and it's listed first within the balance sheet. Why?
Most liquid.
Because it's most liquid, because they're listed in the order of liquidity, right? And that was from one of the chapters we just had. So we can see here, there's the listing, and then it's just showing a little the notes to the financial statements, because we know the GAAP requires notes to accompany the statement. So this is just showing a little excerpt of what the notes to the financial statements would be in terms of cash and cash equivalents, and it's just telling note one, summary of significant accounting policies in part. For cash and cash equivalents, and it's just a snapshot, a little excerpt of it, and it's just telling you why they account for it. Pretty much 3 months, we account for anything 3 months or less as cash or cash equivalents. So that's pretty much just a little snapshot there. It says here, why does Starbucks combine cash and cash equivalents into one amount on the balance sheet? Pretty much same thing, is because it's not going to change. So they're just combined because they're like, right? They're like items, so they're just going to buy cash and cash equivalents because in terms of GAAP and investors are concerned, they're one and the same, right? Okay, so why do businesses need cash controls? Why would you think a business would need controls in place to safeguard cash?
I guess just to keep it safe.
Keep it safe, right? Because we know people tend to be unhonest by nature, right? I mean, not everybody. There's always going to be a couple bad apples, no matter what we're participating in, and whether it's a sports team or whether it's someone in work or whatever. But obviously, cash is the most susceptible to theft, right? Because it's easy to just grab, throw in your pocket, or do whatever, So or just misappropriate, right? Just misuse of those funds, be able to redirect them in a different way. So, well, you want to keep embezzlement from happening, pretty much, or just redirecting those funds for use other than the use of the company. is long and short. So they put internal control systems into place, okay? Um, and these internal control systems are put in place to make sure that the financial reporting is accurate and correct, to make sure that you're abiding with like regulations, with laws and rules of those concerned from authoritative bodies and regulating bodies, regulatory bodies. Um, and also, they also want to make sure, obviously, that we're not susceptible to the theft of cash, right? Um, Sarbanes-Oxley, known as SOX, passed in 2002, which was the aftermath of Arthur Andersen and the Enron scandal. They've actually changed the whole audit of public companies based upon internal control. So now there's a whole nother, they have to do an integrated audit, not only on the presentation of the validity of the financial statements, they also have to do one on internal control over financial reporting. And that pretty much ties into the internal control systems that a company has to safeguard its assets and to make sure that stuff's reported correctly. Cash control procedures, a lot of times, pretty much long and short, this is saying you want to have segregation of duties here, right? So you want to make sure there's a different group of people or a different person that's doing the cash receipts as opposed to, and then a whole nother separate person that's doing the cash payments. Okay, so that's what they're saying here. Long and short, that's all it is. You want to have segregation of duties. You don't want the same person that's receiving cash paying cash out, because then they're going to know what's coming in and going out, and they can alter what the data is. But if you have something that's separated, then this person knows this. They are not allowed to spend the money. They can only collect it. Same here. They can only spend it. They can't collect it. So it separates them to where their functions are just a one function thing. So that's segregating there. So not just one person has control of cash. Electronic payments here. Electronic fund transfers. We know that's just electronic transfer between companies. Accounts receivable conversion. This is when paper checks arrive at a lockbox, they just convert them into a digital check for a more prompt deposit. Check clearing for the 21st Century Act. Scan checks and transmit digital images to the bank. So I'm sure you've probably seen the app on phones. You can scan your check to make a deposit. That's all they're talking about here. Okay. What are the different types of receivables? One other thing I wanted to point out about internal controls, another thing that's really common, you probably could see it a lot of times when companies write checks for payroll, if they still have an actual physical check, which I know most companies now do direct deposits, but back when they did the actual physical checks, which a lot of companies still do that as well, you'll notice there has to be like an endorsement by an authorized person on the bank. So the person that's actually performing the payroll and is printing the checks does not have authorization to sign, because then they could obviously print a bogus check and then just sign off and endorse it and then let it go right out the door. So you're going to want someone separate signing the checks other than who's running the payroll. That once again is another example of segregation of duties to safeguard cash. What are the different types of receivables? So right here, we look at two different types. We have trade receivables and non-trade receivables. First, I'll back up. Receivables is pretty much just an amount of money owed to a company, right? So they've either performed a good or a service or provided something on account to where they're due money, right? They've satisfied their performance obligation, right? So trade receivables, these are what arise out of the normal course of operations for a business, whatever their main revenue producing capacity or capabilities are. So those are going to be your original accounts receivable, known as AR. These are customers' obligations for goods or services in the normal course of business. Notes receivable, these are more of an unconditional written obligation or a promise between two people, meaning it could be either from a supplier and our company, or from our company and a customer. And it's just more of a long term. It's still within that year, but it's going to be a little more long term than the normal course of just the accounts receivable. Okay, because accounts receivable are usually within 90 days that we've account for those. Non-trade receivables. These arise from transactions that are not directly related to the sale of the company's goods or services. So it could be something else. Maybe we do an advance payment for someone for a payroll check or something like that. They make a note that they're going to pay us back. So that's obviously not going to arise out of the trade or normal practices of the company. It's going to arise for another situation. Catch my nose here. Sorry. Okay, next, overview of receivables. So you can see here we have trade receivables, and that's going to be the recording of accounts receivable. We have the initial recognition of whatever the accounts receivable are. Trade discounts, if any. So a lot of times we offer trade discounts to people to entice them or incentivize them to buy our products. Cash or sales discounts, that's to try to incentivize prompt payment. Sales returns and allowances. So if we sell something, it's defective, they return it, or maybe they keep the product, so we give them an allowance, a discount off the price just for whatever the damage was. So maybe you buy a refrigerator and it's got a dent in it, they give you an allowance towards it. Um, Valuation of uncollectible accounts receivable, we have an allowance method and we have a direct write-off method. Direct write-off, that actually is not permitted with GAAP. It actually goes against GAAP. Allowance method is the method that we'll use, okay? Because this goes with the matching principle. This does not go with the matching, because the direct write-off, we just write it off. It could be in a period other than the sale. The allowance, we're just going to account for it based upon the income statement or balance sheet amounts, and we'll get to that later. Um, Financing accounts receivable, we can either do a secured borrowing based upon our overall accounts receivable, um, or we could actually sell them or factor them out. Notes receivable, interest bearing notes, non interest bearing notes, and sale and assignment of a notes receivable. Okay, so just a little bit about trade receivables. So how are accounts receivable recorded? So the revenue recognition principle says that its revenue is recognized when a company satisfies its performance obligations, right? Um, so it says here, obviously, whenever the performance obligation is satisfied, that means that we've recognized revenue whenever we've transferred the good or service or whatever it might be, right? Receivables should be recorded at their present value, but GAAP excludes accounts receivable from this rule because of the short-term collection period. Usually, like it says here, generally 60 days or less. A lot of times it's 90 days or less too, but it's usually you want it within those 60 days. You want it quicker than that, really. You want it within 30, but the 60 to 90 is really what the aging report shows. So it's realistically it's about 90 days because you have those a couple bad apples or slow payers that are slow to pay. So this allows us to count for it at net realizable value, right? It makes sense because of once again back to that risk of the same rule as the short or cash equivalents because it's such a short amount of time. So that's why it allows us to count for it at the net realizable value. Okay, trade discounts and cash sales discounts. It says here companies frequently offer trade discounts or quantity discounts, and this is once again just to incentivize our trade partners to buy from us as opposed to our competitors. So we're going to give them a discount on a bulk purchase, or maybe we just give them an overall discount. Once again, that's to incentivize customers, and also it could be used as a means of hiding whatever our cost is or whatever our true price is from competitors, so they can't benchmark off of us as easier, and it helps maintain our competitive advantage. Um, so cash discounts as opposed to trade discounts. This is more so when we've sold an item to a customer. So a cash discount is something that we try to use for like to try to give an incentive for to receive prompt payment. Okay, so usually what the way that cash discounts will be expressed is going to be like here 210 and 30. What do you think this would mean right here? Have you ever seen that term before?
Yeah, I think so. Is that 2% off if within 10 days
Right.
and it's required within 30?
Exactly. So 2% off if we receive payment within 10 days from the transaction date. And then if you do not take the discount, then you have a net of 30 days that when your payment is due. And obviously if you don't pay within 10 days, you forego the discount and then you have to pay the full principal amount, right? So awesome. That's exactly what it means. And it says here cash discounts have made two positive effects, obviously. It stimulates faster payment from customers because it entices them to pay because they're getting a discount. So that's a good thing. We're getting cash up front, so that gives us cash for the use in current operations, which is nice because it's all about cash with the company, right? We need the cash for operations and to satisfy obligations. So that gives us the cash up front. And also, if we're getting the cash up front and incentivizing people to pay up front, then obviously then it's going to reduce our overall aging of accounts receivable. It prevents an account from becoming stale and prevents the possibility of having to write off an uncollectible account or making an account become uncollectible. So that's some good things on cash discounts. Net price and gross price methods, pretty much what this is saying, if the selling company extends cash discounts to its customers, it can use either the net price or the gross price method to account for the variable consideration. Okay, so pretty much all this is saying here, if we're a company and we're selling goods to an outside party, then we can either record that transaction, we can either record the sale at the gross amount with no discount, so just record it for the gross amount, or we can record it for the net amount, right? Just net of the sales discounts, okay? Okay, so if the customer pays and takes the allowable discount. So we'll just go ahead and read through this real quick. So if when using the net price method, we record the net invoice price after deducting the expected cash discount. We said that, right? And both the accounts receivable and sales revenue account at the time of sale. So if the customer pays and takes the allowable cash discount, then the company records the cash receipts and reduces the receivable, no adjustments necessary, because it's exactly what it was. If they do not take the cash discount, then it pays an amount that is greater than the amount the company recorded as the receivable, and then the company recognizes the difference as revenue, right? So that then we'll see the examples here down in just a second. The opposite end, or the flip side of that coin, if we use the gross price method, we're recording it at the gross amount, and then if they take the discount here, takes the allowable discount, then the company records the difference between the cash received and the original amount of accounts receivable as a reduction of revenue. Okay, so if we use the net method, the net price method, and then they end up taking the discount, then it's fine. We just reverse it as is. If they don't, then we include the additional as revenue, right? The difference in the cash received. Same thing, flip side of the other one, we just reduce the revenue if they end up taking the actual discount. Okay. The gross price method, it says it has two practical advantages. It simplifies communications with the customers. Say if they do not take the discount. So then when we call to try to like settle with our bill and we say, hey, you owe this, okay? If we record it at the gross amount and not at the discount amount, then we don't have to argue with them later like, okay, well, no, the reason why this is so low is because we gave you a discount, but you didn't take it. So really you owe us this, but instead we recorded it as this initially. So if we just initially recorded it gross, it can eliminate that argument down the road in case they're a trouble account, right? Or a doubtful account, which is a better term to use. And it requires less record keeping and is more cost effective. So obviously, if the more record keeping you have, the more expensive it's going to be for data entry, okay, and more time it's going to take. So it's more effective, and we'll see that in the examples of these entries right here. Alternative methods of accounting for sales discounts. This is the net price method. So we're actually recording it at a net amount now. So after net of the discounts. So to record the sale on December 1st, we can see here, this is the accounts receivable. So say it's $8,000 was what the gross amount was, and it's a 2% discount. So obviously we just back out 2% of 8,000, right? Is all this formula is showing here. 8,000 minus 2% of 8,000. And that's going to give us $7,840. So that's our AR, and then count of sales revenue. When we receive the payment on December 10th, so we can see here, cash $53.90, accounts receivable $53.90. To record payment received on December 30th, cash $1,500, accounts receivable $1,470. And then right here, the difference between the two, we have to account for additional sales revenue of $30 because they foregone the thing here, right? So we have to account for the additional revenue. But then you see here at the end of the period, we have to make an adjustment between the accounts receivable and the sales revenue right here. So that's why it's saying that the net method requires more work, because there's an adjustment at the end of the period. Does this make sense? The same thing we just talked about?
Yes.
You seeing that in the journal entry?
Now, what exactly is the adjustment for?
This adjustment here is because, remember, we recorded the sale up here at the net amount, right? And you can see here, this is what the total amount of payment is, right? Well, we only received a portion of that payment within the 10-day period. See the date? Because it's 2/10 net 30, right? So we only received a portion of it, but then later they had to pay more money on the payment received on December 30th, right? So right here, we're like the accounts receivable sales revenue have to be adjusted for the difference on the discount that wasn't taken.
Okay.
And that's all that is. Just and don't even worry about the math right now. That's just an adjustment, having to adjust the difference because of the way we initially recorded it. Okay, so now that's why there's an extra adjustment. That's the only thing I really want you to be concerned with, to know that there's an extra adjustment because the difference between the discount that was applied and then if they don't take it, we have to adjust for the revenue. Okay.
So the $1,000 they didn't pay yet is adjusted for the discount that they can't take advantage of.
Right, they can't take advantage. So that's where we're just, see here now we're just accounting for more revenue now. You see the extra sales revenues, the difference between that, right? Because here's this, and then here's more sales revenue, and then we have to adjust to bring more accounts receivable on and adjust the revenue at the end of the period. Like I said, don't really worry about the numbers here. This just I want you to just see the actual visual of what we were saying about how there's an extra step involved in the net, because we've recorded it net, and now if they don't take the discount, we have to adjust revenue. Okay, so that's why obviously the gross method is the best method, because we saw that it eliminates the argument and it's cheaper, and look now here, there's no adjustment here, right? So now we're going to record it at gross. Now we're going to forget about the discount. If they take it, great, we'll adjust that if they take it. So now to record the sale on December 1st, look, the accounts receivable was the full gross amount of 8,000, sales revenue 8,000. That's easier even from the inception of the entry, right? Like the first entry is even easier because it's just the full amount. We don't have to do any calculations, anything. There it is. Here to record payment received on December 10th, cash. So here's now that we're going to give them this discount here, and then this time we're just going to reduce sales revenue because they actually took the discount. Does that make sense? Because we included the revenue up here because we recorded it gross, but now they're paying some of it up front, right? So we're going to give them that discount on that payment, and then we're going to adjust our sales revenue back based upon the percentage that they paid, right? And then when we record the other payment, the remainder of it, of the 1,500 right there, cash, accounts receivable, and then there's no adjusting entry at the end. Does that make sense? Like I said, I'm not really as concerned with the numbers, of just more so than just the debits, credits, and how it flows through. So the gross method's going to be the preferred method. Okay. Does that make sense to you? Okay, sales returns and allowances. So obviously, sales returns is when the customer returns the goods back to the seller. Sometimes goods are sold that turn out to be defective. The customer may retain the goods, and once again, we give them a sales allowance, right? So we just give them a reduction in the price, right? Companies should record the estimated amount of future returns and allowances in the period of sale to correctly report net sales revenue and net realizable value of accounts receivable. So once again, this is the allowance method we're talking about. We want to match it with the sales, right? So whatever we think would be the sales returns or allowances or uncollectible accounts, we want to account for that in the period of sale because we want to match revenues and expenses in the period in which it happened, right? The period in which it occurred. So a little example of the sales returns and allowances. Barclay Corporation sells 500,000 worth of goods, and the company estimates that returns and allowances will be 2% of sales. To record the sale and its estimated of return and allowances, Barclay records the following entry in the period of the sale. And this is assuming it uses the periodic inventory system. So if we sold 500,000 of goods, right? So that's going to be our debit, accounts receivable at the gross, right? Because we need that gross line item on the balance sheet. So accounts receivable for the gross amount of the sales. And then sales revenue would be 500,000 times 0.98, right? Less the 2%. So see that? We're just backing that 2% of this out. So that'd be 0.98. And so that's going to give us 490, and then the return liability is the 2%, right? We think we estimate that 2% of these goods sold is going to be uncollectible. So we're just setting up our allowance for doubtful accounts. That's what this is right here. Return liability is 10,000, right? Okay, so it says here when sales returns and allowances of 8,000 actually occur for goods sold on account, Barclay records this transaction as follows. So return liability, so we're reducing liability we originally set up, right? And we're reducing that and then reducing accounts receivable, right? And that keeps everything matched within the period as incurred. So right here, that reduces our accounts receivable down to the net realizable value. only counts the amount of revenue we expect to collect. And then later, when we get it, if you can see here, it's not going to affect revenue. It's only going to affect the liability account and the receivable account. So it's not going to affect earnings there. That's why it's keeping it intact and matched. Do we see that? So how are uncollectible accounts receivable estimated? So once again, there's always a risk the company might not collect accounts because we're extending on terms of credit. GAAP requires companies to consider the uncertainty of collection and valuing accounts receivable on the balance sheet and expected bad debts to be estimated and deducted from income and assets. So we know that net realizable value, by doing so, we would reduce the earnings so that both things are accomplished within that entry. Trade receivables are normally valued at net realizable value, which is obviously the amount we expect to receive in the future from the customer. Two different methods for uncollectible accounts being recorded. Once again, we have the allowance method and the direct write-off method. The allowance method, this is where companies record uncollectible accounts in the year of sale based upon an estimate of the amount of uncollectible accounts, all right? So that's the allowance method. That keeps it matched like we've been talking. The direct write-off, this is just companies record uncollectible accounts when they determine that a specific customer account is uncollectible. So we could make a sale this year in 2020 and then carry that account all the way out to 2021 or 2022 even, not a good practice, but carry it out and then say, you know what, this person's not going to pay. Let's just write it off. So obviously that's an expense in a period in which the sale didn't occur because the sale occurred in 2020, but we're writing it off in 2021. So you can see how that just goes against the matching principle of GAAP. That's why it's not allowed under GAAP, right? So under the allowance method, a company forecasts the expected future bad debts in the accounts receivable. So that's a forecast of credit risk, pretty much, right? Because we know if we're extending stuff out on credit, then there's a risk we might not get it back. They can use multiple methodologies, including historical bad debts it has incurred, a credit risk strategy and policy, industry-wide experiences, and historical trends and economic conditions. So there's some leeway here, and just using some professional judgment here on terms of the account. It compares this information to its current sales or accounts receivable to determine the relationships to use estimate in its current uncollectible accounts. So these just provide stuff that we need to be able to calculate the bad debt for the period. So now let's talk about the allowance method. It's when the company records the estimate of bad debts. The journal entry is the debit to bad debt expense and a credit to allowance for doubtful accounts. So that's going to be our entry at the time that we set up this account. Here's an alternative that says allowance for bad debts or allowance for uncollectible accounts. So any of these, it's just the terminology here, but it's all the same thing. The bad debt expense is normally reported on the income statement as an operating expense. Allowance for doubtful accounts is a valuation, a contra account that offsets your AR on your balance sheet. Okay, offsetting allowance for doubtful accounts against accounts receivable informs financial statement users of the net realizable value, so the amount we actually expect to receive from those trade receivables, right? So once again, what does that tie into? What theory? Matching and the conservatism, right? Because we're not going to overstate those accounts receivable. So we can see here still how that framework ties into everything that we're doing out on these financial reports. Estimating bad debt, we can do it by either a relationship to credit sales. That's the income statement approach. So that's just the percentage of net credit sales, right? And it's only the credit sales we're concerned about, right? Not cash sales, only credit sales. So watch that when in the terminology of the questions, we're only concerned with credit sales in terms of AR. So once again, we have the income statement approach, percentage based upon net credit sales. And then the relationship to accounts receivable, which is obviously the balance sheet approach. So then this is just going to be for the percentage of the overall AR outstanding. And then there also has to be an aging of accounts receivable if we go on the balance sheet approach here. So we have two different types of approaches for AR: income statement based on net credit sales, and the balance sheet based upon the overall gross balance of the AR on the balance sheet. And that requires that or triggers the aging of accounts receivable. First method, the percentage of credit sales. Estimating bad debts based on the relationship of credit sales matches current bad debt expenses against current credit sales. So once again, that's the matching concept coming back to play again. The income statement method results in recording bad debt expense in the period during which credit sales occur. An example here, Lima Company's net credit sales during the year were $525,000. Bad debts have historically amounted to 2% of net credit sales, and current conditions indicate that a 2% bad debt loss is likely for the current year. Lima makes the following entry, following year-end adjusting entry. So once again, at the year-end, that's when we're going to adjust these, or period end. Usually, monthly we're going to do these, right? So we're going to have these monthly closing entries, then at year-end too. But in this example, year-end. So bad debt expense, once again, we're basing it off, this is the percentage of credit sales. So once again, just 2% of the 525 is going to be 10,500. So we just debit bad debt expense, hit our income statement and the operating section of the income statement, right? And then we want to credit the allowance for doubtful accounts, which is the contra account on the balance sheet, which is going to be right below the line item of accounts receivable on the balance sheet. Pretty straightforward, right? Percentage of outstanding accounts receivable. So it says here, bad debts may be estimated based on the relationship between the actual amounts not collected and accounts receivable, balance sheet oriented. Once again, the goal is to determine the ending allowance for doubtful accounts and appropriate net realizable value of accounts receivable. The example here is Weir Company has determined that historically there has been a 4% relationship between actual bad debts and the year-end accounts receivable balance. Weir's accounts at the end of the year prior to adjustment are as follows. Accounts receivable, 475,000, and allowance for doubtful accounts of 4,500, which is a credit balance, right? So the allowance for doubtful accounts, the current credit balance is $4,500. We got that from the last slide. The required adjustment is 19,000 minus 4,500. So the 14,500 is the required adjustment to get us to the 19,000 required ending balance, which is 4% of $475,000. You seeing that? So the first one, accounts receivable 475. We said the actual bad debts is 4% between the actual bad debts and year-end accounts receivable. So 4% of that is going to be the 19,000. But it was currently a credit balance of 4,500. So the only adjustment we need to make was the difference between 19 and 45, okay, to bring us up to the 4%. So at the year end, that entry would be the difference, the 14.5. So we debit bad debt expense, once again, operating expense on the operating section of the income statement. Allowance for doubtful accounts, once again, credit contra account on the balance sheet. Pretty straightforward, right? Main thing here is on the allowance method. If we're basing it on the percentage of over AR, we need to always check to see what's in the contra account already or in that allowance account, because we just want the difference. That's what the adjustment is. A lot of times it's easy to just make that overall adjustments for a total 4% without considering what's already in the allowance method, right? Or in the allowance account. Sometimes they could even give you that allowance account in a debit balance and then tell you what the credit would need. So if that would be the case, then we would have to add whatever the additional debit balance would be to bring that credit up to get it out of the debit balance, right? Make sense? So aging of accounts receivable. This is just a little example here. So we can see here's a balance 12/31/19. Here's under 60 days, 60 to 120 days, 121 to 240 days, and all the way out to a year. So, and then here's over a year. So pretty much we just have the balances from each company of what's owed as of this date, and then it's just showing the status of the breakdown of each of those amounts. Does that make sense? So we have the overall balance of AR. So this right here will be on the balance sheet, right? But then here's just the schedule showing the age of it. So it says here, individual accounts receivable are classified based on the length of time they've been outstanding. An estimate of the allowance for bad debts is computed by applying appropriate bad debt percentages to each category, right? So what that means is, like, this percentage might be 1%, this percentage might be 4%, this percentage might be 15%, this percentage might be 50%, right, uncollectible. So we have to do each relative percentage for based on each relative category. Makes sense? Aging of accounts receivable, once again, under 60 days, here it is. That's the gross amount, 2%. Same thing we just said. This just showed that 60 to 120. This amount is a higher percentage because it's older, so on and so forth. So the the older the account receivable ages, the less chance you're gonna collect it. Make sense? Okay, writing off uncollectible accounts. Okay, yeah. So we'll stop at not this slide, but the next one. So writing off uncollectible accounts. When a company determines that an individual account is uncollectible, it writes that account off, right? So removing it from accounts receivable, credit, and reducing allowance for doubtful accounts, debit. For example, a company writing off a 1,000 accounts records this journal entry. So now we debit the allowance for doubtful accounts, and then we credit accounts receivable. And we can see here this keeps up with the matching concept because we're not hitting revenue right here. We're not affecting income, right? Because now we're reducing. Remember, when we made the original sale, we set up the allowance. Now, when we actually write off something, that's what the allowance is for writing off these accounts. So we're going to hit the allowance as opposed to hitting the revenue, right? So we hit the allowance, reduce the allowance by debiting it, and credit the accounts receivable because this removes the accounts off the books, right? This write-off has no effect on net realizable value of the accounts receivable because the allowance account and the accounts receivable balance are reduced by the same amount. So no net effect. The allowance for uncollectible accounts is an estimate and always involves future uncertainties. Okay, so we know that. Collection of an account previously written off. Okay, this will be our last slide for today. So most accountants favor reestablishing the customer's account receivable and then recording the payment. Okay, and I totally agree with it. I think it's good to reestablish the account receivable just to get it back intact, and then we can go from there. So, for example, if Uphoff Company receives a $300 payment from a customer whose account had previously written off, the company makes the following journal entries. So the first thing we want to do is just completely reverse what we did when we wrote it off, right? So now we want to bring the AR, the account receivable, back onto our books. So that means we have to debit the account receivable and then credit the allowance for doubtful accounts, right? So now accounts receivable is back intact and the allowance is back intact, right? As if the write-off never occurred. Okay, so the next thing we want to do, so now we put the receivable back on the books and brought the allowance back up to the original threshold that it was at before. And then now we want to actually collect that receivable. Same thing as always would be debit cash, credit AR, right? First entry reverses the initial write-off. Second entry records cash collection in the usual manner. Pretty straightforward, right? Okay, so next we'll on class on Monday we'll get into the direct write-off method. We're right exactly about halfway through the slides, so we'll finish up the slides Monday, and then Wednesday we'll work problems. So that's my goal, is to hopefully moving forward try to get through the slides in a day or two. We might mix it up and work problems while we go through the slides, but on this lecture here I wanted to get through the slides first, and then like I said, Monday we'll finish the slides, and I'll have the test. We'll talk about that for a minute. And then on Wednesday we'll work through some problems here, and like that we might see on homework or quizzes and our tests, stuff like that. Everything sound good? All right, cool deal. Well, I appreciate your time, and I guess we will meet again on Monday. Everyone have a good weekend and a good day.